everybody, and thank you for joining us today. I'm Alex Sasso, portfolio manager and part of the team helping to manage the pension portfolios. I have with me today John Poulter, the Chief Capital Market Strategist for NCM and the lead portfolio manager for the pension portfolios. Before we begin today, just some housekeeping issues. We're using the Zoom webinar in presentation mode. This means your microphones are muted and your cameras are off. However, in addition to the questions that we've already collected from a few advisors, you are free to send questions using the Q&A function at the bottom of your screen in Zoom. As well, the webinar is being recorded and will be made available to watch. Remember, if there's anything that you need, just send an email to sales@ncminvestments.com and someone from our sales group will follow up with you. So today, the title of the presentation is Resolving Risk in Your Book, with a specific focus on CFR or client-focused reform. So back in October of 2019, the CSA released its final amendments to National Instrument 31-103, in which CFR was designed really to align registrant conduct requirements with the interest of clients. I guess said another way, the purpose of the client-focused reform was to improve the outcomes for clients and make clearer the nature and the terms of the relationship that you have with, or that the client has with registrants. And those registrants would be advisors, they would be you, they would be employees, they would be agents, and even the dealer. So the provisions came into effect December 31st, 2021, and they include KYP, which is Know Your Product, KYC, Know Your Client, suitability, and new relationship disclosure rules. Next slide, please. So, what is the problem in and around CFR? Why are we having this conversation? You have new requirements placed on you that you should be aware of, some that you are already aware of and some that you may not be aware of. Take, for example, some very popular investment products out there. They may cause issues in your book of business, and those are things that you should be aware of. The new conflict of interest rules have changed. Firms and registrants, i.e. you and I, we have, to identify material conflicts of interest that exist or are reasonably foreseeable. So there's new rules coming into place, and they must be addressed in the best interest of clients. And disclosure is not only a requirement, it can't be an excuse. You can't say, well, I disclosed it to the client and therefore that settles the conflict or the issue. You may own proprietary products which also have strict conflict of interest rules. For example, you can't be compensated for a proprietary product any differently, i.e. there can't be an incentive to buy a proprietary product over a non-proprietary product. You have to show that the same KYP rules apply. You have to show why proprietary products fit in the firm's business strategy. And you need to tie this in with the client and how they align with the client's best interests. And it can't just be lower fees for the sake of lower fees. It can't just be better performance for the sake of performance. It has to be a combination of factors. You and your compliance team have to monitor the use of and the level of proprietary products. You have to make non-proprietary products as easy to access. You need to disclose to clients the extent to which you think you may be using proprietary products in their portfolio. And your compliance team and your firm have to have an independent evaluation of the effectiveness of the firm's policies and procedures all in and around proprietary products and how the firm is going to control the conflict of interest with proprietary products. Anyways, that's one of many different topics that need to be discussed within this conversation. And there's a lot of information. So we're helping you to resolve some of these issues. And you can see resolve here is a verb in this slide, to find an answer or a solution to something. Next slide, please. So speaking as the product manufacturer, the one thing that we can help you with certainly is KYP, know your product. And if you think of CFR, there are 4 components to CFR. As we talked about, there's KYC, there's KYP, suitability and conflict of interest. We're going to concentrate this conversation more on KYP. Next slide, please. So within KYP, there's 3 components. There's fees, there's performance, and there's risk. And fees are what fees are, and they're easily monitored. Performance is what performance is, and it's fairly easily monitored. You can measure both of those. Risk is a little bit more subjective, so we're going to spend our time talking about risk. So next slide, please. There's a lot of information on this slide, but back in the 90s and the first decade of this century, the biggest funds were those that performed the best. That was the rule of thumb in the industry. He who had the best performance in a category that was flowing received a lot of the fund flows. After all, performance was net of fees, and typically a market participant was in there for a long-term period. And then I think what happened in 2008, and with the onset of this new product called ETFs, that changed the way investment products were purchased. All of a sudden, we had products that were priced differently than the flat standard 1% fee. And this, I think, in combination with CRM, disrupted the investment world. And all of a sudden, performance wasn't the only major decision point. So legislation tends to change industries. We all know that. And this new legislation had a significant impact in the way that you do business and the way that we do business. And then in 2018, with the introduction of client-focused reform, this is another example of that change. And we think it's going to change the way you do business and the way you look at your book. Now, suitability and risk are key building blocks in and around the way that you will be buying investment products. Next slide, please. So in this slide, what we're showing you is how the CSA looks at risk. There are 5 buckets from low risk to high risk. You have low risk on the left side in the navy blue color, red on the right side, denoting the high risk bucket, and then you have 3 buckets in between. Now the CSA looks at these buckets, defines these buckets by standard deviations. They are formulated via 10-year standard deviation calculation. The low risk bucket is 0 to 6% standard deviation points. The high risk bucket is over 20% standard deviation points, and they're separated by anywhere between 4, 5, or 6 standard deviation points. And that's kind of how the CSA defines it. It's not the way I necessarily think is the best way to define it, but I wasn't at the table at the time. Nevertheless, what is interesting here is that most dealers, i.e. your compliance officers, will likely only have 3 buckets, not the 5 that the CSA is showing us on this chart. Many of those compliance officers will take the low to medium risk bucket, and they'll put all of those investments into the medium risk bucket. Then they'll take the medium to high risk investments that fit into that bucket and place it into the high risk bucket. So this is important and has important implications for you as an advisor, in that if your client's KYC says low risk, then it's very hard to own most investment products. But even if your client is a medium or medium to high risk KYC rated client, then it's difficult to own medium high rated products, knowing that your chief compliance officer is going to classify those into the high risk category. So one strategy here would be to add a low risk product into your portfolio or your client's portfolio in order to lower the overall risk rating of the portfolio, assuming, of course, that your dealer or your chief compliance officer will allow that methodology. Now, what is interesting here is that the majority of the investment dollars in Canada fall into a category called global neutral balanced funds. Do you want to go to the next slide, please? So the marketplace is heavily dominated by the global neutral balanced category. it's 2 times the size of the next largest category, which is global equity. You can see that on the left-hand side of this slide. And you'll also notice on the right hand of the slide, what we're showing you here is the top fund categories by inflows. You can also see that not only is it the largest category by size, it also attracts the most dollars. Why? Well, frankly, this is the sweet spot of demographics. It's for older and more conservative clients. Do you want to go to the next slide, please? Now, you can see that less than 10% of the category is rated low risk. So the vast majority of the funds in this category are rated medium risk. So many of you or other advisors that are using the precious little room that they have in the medium and high risk portions of their clients' portfolios on this one category should be thinking about using it in low risk rated investments. But you'll notice that only 34 of the 342 global neutral balance funds are rated low risk. Next slide, please. And what we're showing you on this slide, this is the risk rating of the 10 largest funds. They represent about 1/3 of the biggest category, that global neutral balance category, and are all rated higher than low risk. But we think we have a solution. And I'm going to pass the baton over to John Poulter to help explain what that solution is.
Thanks, Alex. If we could advance the slide. I'm going to be talking about the balanced income portfolio for the balance of the presentation, and it talks specifically to the bracket of funds that Alex has introduced us to, being the global neutral balanced funds. And I'd like to think that our fund is unique in that its holdings are unique, and how we come about our asset allocation and risk management. And that risk management actually has the fund showing a low risk rating at the moment, which is unique in its group, given that there's over 300 different funds in this category, and only counting in the 30s that are low risk. So we believe that it's a solution for the low risk client that's looking for a balanced mandate. And I'm going to start off by talking about the performance of our fund since we've launched it, and that'll be on the next slide, please. So our fund now has gone through its third year. Most of the information on this slide is self-explanatory. After the third anniversary, which was fourth quarter of last year, we're pleased to report that the fund's in a solid second quartile result on the quartile performance measurements. Last year was a tough year to keep up with the massive recoveries that we saw in a lot of funds in most and in most equity markets. But we finished the year with a Q1 rating, which we're very proud of. But I will point the attention to one number on the slide. It's a glaring 4, which is represented by our ranking in 2020. And it really represents a 3-month event. Of course, that event was COVID, but I think it bears some focus. The fourth quarter result was due to an asset class that we held that reacted to COVID in a very negative way. The asset class held terrific short-term high-yield investments, but illiquidity led to an outsized, unsurprising downside volatility. So that asset class has been removed, but it did give our performance, which has otherwise been 1s and 2 quartiles here on this sheet, a black eye for that one quarter that resulted in the year. So, we'd like to think that the COVID result was, maybe a 40-year event, but even given that, we now believe the illiquidity we had will not impact us again. So as I said before, we're very happy with the fund's performance. It's been performing as we designed it to, and we don't see any reason why we should see different results going forward. We can move to the next slide, please. The fund itself is allocated among what I would call fairly concentrated positions in actively managed mandates. And the green pie slice indicates here the active managed portion of the fund. We believe this is both unique and a significant advantage when we're seeking higher returns and also managing risk. Tactical model will direct you to adjust the big pieces while managing your allocations. That means regions and your asset classes themselves, stocks versus bonds. But active management allows you to take a next step in the risk process and to tilt equity to equity attributes and fixed attributes that we'd like to focus on. We've executed this advantage on a number of occasions, and it's pretty simple. For example, in Canada, we have two programs. One's a low volatility program, and the other one is highly focused on valuation and growth biases. I could allocate between those given the environment. While it's an overweight today, Canada can be fine-tuned to be, specific to those attributes that we find timely. We also apply this to our fixed income assets, and we rely on active management to help us navigate an increasingly complex fixed income environment. And right now we use partially structured fixed income active management, but we also use some thematic ETFs to give us specific themes that we don't have in our active program. So, and that leads to the question of the blue piece of the slide, and that is thematically driven assets. And these reflect our targeted affinity to specific components of capital markets. And I'm going to elaborate on that as we move to the next slide. This particular slide shows us how we are asset allocating to passive, but very, very thematically driven passive strategies. If you look into a pension and into many institutional holdings, you'll see, along with being very globally oriented, they're also concentrated in certain identifiable themes. The pensions like to own real assets, and they also like to hold renewables, and they like to tilt their portfolios to long-term secular growth. And we capture this thinking and investing by dedicating a portion of our pension ETFs, and that's the green slice here that's represented, into what I call our real and renewables, which is the global water, global agriculture, global infrastructure, and global real estate, and also into the long-term growth ideas that are embedded in the what I think is called the new economy, and is showing long-term secular growth themes, and that's in electric vehicles, cyber securities, clean energy, and then something we call leisure and entertainment, which focuses on electronic games and things like that. So we'd like to think that we're emulating what they're doing in the pension world by looking very thematically at the various aspects of institutional holdings that we don't actually have a dedicated desk trading. So we can move to the next slide, please. So we also are active in our and concentrated in our active management and fixed income, and specifically we manage risk by managing themes, and our fixed income allocation, which is shown by the green and the red slices, have been quite successful in the recent environment, given that we've had the latitude to tilt to shorter maturity assets, and also given our outlook on the economy, we've also tilted towards higher credit and higher yield assets in this space. So this is another example of a non-market and a unique solution that kind of straddles our ability to do active management, but also look into the very specific themes. So in our short-term investments, we balance our fixed income between governments and short-term high yield. And then in our longer-term assets, which is the other half of the portfolio, we have investment-grade corporates and also some longer-term high yield. We can move to the next slide, please. So to recap on concentrations and active management, I'll say that they actually go hand in hand. And in the context of our global balance funds and the pension funds are fairly well concentrated. And this differentiates us against some of the other funds that we see in this market space, particularly in comparison to our competitors. We hold 132 equity positions across USA, international, and Canadian markets. And if you look at some of the competition out there, which we did when we were building the pension funds in the beginning, we found that some of them held thousands of different positions. And generally this meant that they owned the market. They own thousands of pieces of individual companies that make up the market. And given that, they're unable to target characteristics and factors that identify either identify into alpha production through value and quality, or in risk mitigation, such as the low vol Canada fund that we have. The other very important thing here is that we don't own the market by taking the attitude that we're going to be concentrated and very dedicated in the securities that we hold. And sometimes rolling along the market is an easy way to go, but we don't think that that's necessarily the way you want to be managing your portfolios today. So we have 132 positions. We target those positions toward characteristics such as quality, which we find in balance sheets. We target growth and earnings and ROEs. We do this by keeping an eye on the valuation profiles. And we can also specifically risk manage by going into something like, I use as an example, the low vol Canada fund that we have. And again, I'll reiterate, we don't own the equity market by operating in this capacity. We also concentrate our fixed income. We've got one of our managed active portfolios has 39 positions. This portfolio targets maturities. It also targets specific structures, which is important in the current market today. And it allows us to make an active selection across credit and yields. So, and this gets me to my last slide, please. And my last slide is a little bit theoretical. It shows you, a well-used risk and reward concept called the efficient frontier. This is depicted in the curve, and it simply produces a concept of returns versus risk. And the portfolios along the outer edge of this curve are portfolios that are creating the optimal return per unit risk. And I'd like to think that the arrow is somewhere around where our portfolio would be, given that we're showing decent quartile returns, first and seconds in most cases, but we're also doing it with a very low risk. So I'd like to think that our risk reward is showing very well against the competition. And I'd also add that even adding this fund to a bundle with other balanced funds would have the result in moving that client bundle out towards the green curve line, which again, is the efficient solution, showing your best amount of return for the risk that's embedded in the portfolio. So I'll stop there and pass it back to Alex to just wrap up what we're doing with our slides.
Yeah, thanks, John. Well done. If you could forward to the next slide, please. So sort of our conclusion slide before we get to the Q&A section. So we're made for advice, and our portfolio managers are accessible, our wholesalers are accessible, our senior managers are accessible. We're here to help you navigate CFR. CFR is a bit of a game changer in the industry. Again, performance, and fees are fees. Those are easily measurable. Risk is a little bit of a different bucket. It's a little bit subjective, but it does have some characteristics that we can measure. But the pension portfolios are a really interesting one-ticket, easy to purchase solution that have been really well designed. And for the 3 years that they've been around, they've performed over that time period extremely well, given that we've had two really big events. We had the correction in Q4 of 2018, which is a big event. And then, of course, we had COVID in March of 2020, and it continues to linger with us. But the funds have been battle tested and they performed very well. Again, this particular fund, the Balanced Pension Fund, it continues to sit in that low risk bucket with a very low standard deviation. Maybe if we can go to the next slide, we'll just toggle over to questions. And as is usual, I talk too long and John talks too long, so we're almost out of time, but I'm going to try to squeeze in a few questions here. John, speaking of risk, there's a whole bunch of different definitions of risk. I like downside deviation. Some people use beta. We talked a lot about standard deviation and the CSA using standard deviation. How do you think about and define risk?
I knew this was going to come up given the risk focus on this presentation, but I had a slide. I don't know if I made it into it. If you have it, you could put it up because it makes that definition of risk. But basically, standard deviation is what the regulators are focusing on. But there's standard deviation, downside deviation, beta, value at risk, capital impairment, cash flow interruptions. They're all risk concepts, and they're associated with variability and the interruption of cash flows. But standard deviation is the most commonly used because it's easy to understand, but it's not necessarily the most relevant. And understanding that downside risk is probably more important. You can have a portfolio with very low standard deviations that can have its historic return interrupted or significantly by having a downside drawdown, which isn't necessarily measured by the standard deviation. So that's what the Sharpe ratio measures. I would tell people to look at the Sortino ratio, which actually looks at the downside deviations, because quite frankly, investors don't mind the upside deviations that occur that can create higher standard deviations, but they do not like the downside deviations, and that's the one we should focus on.
I haven't met anybody yet that had an issue with upside deviation. So I don't think I will ever meet anybody that has an issue with upside deviation. So thanks for that, John. But you and I, we spend a lot of time talking about deviation. You and I are both on the asset allocation committee when it comes to the pension portfolios. Maybe talk about the decision-making process and how risk is embedded in those pension, that risk conversation is embedded in those pension portfolios.
Sure. When we look at risk, we dissect it by asset class. I hope I kind of illuminated that in the discussion with the slides. But basically, we look at the fixed income portion of the portfolio quite different than the equity portion. And when we're looking at fixed income and doing our risk management, we can actually be fairly precise and direct the allocations towards specific risks. So if a manager thinks, as I have for the recent past, that rates are going up, then we can, shorten our maturities and try to get out of the way of a, bad price reaction based on higher interest rates, and our concentrated and active positions allow our fixed income managers to do that as well. If you think the economy is going to roll through fairly strong, then you can look to credit markets to increase your the yield in your portfolio, and you don't necessarily have to do that by going long term. So that's fixed income, and that's risk management at the asset class level. Diversification comes into play when you're looking at the equity risk management, because we can diversify across regions. We can also diversify across targeted attributes, which again gets me back to the active solutions in our portfolios, where we can take themes that will focus on value when value is going to be important, like I think it is today. But we can also try to focus in on what's going to be lower volatility asset exposures in equity as well. So these are the things that we can manage in the portfolio, and like I say, you look at them individually by asset class, and in the case of equities, attributes and regions.
Yeah, no, that's great. And the great thing about these products is they're diversified by geography, they're diversified by country, by industry, by theme, they're diversified by currency. They're very well diversified group of portfolios that are, again, in my opinion, very well built. But you mentioned earlier, John, that you thought that part of our strategy is to create a more concentrated portfolio than our competitors. Does that increase the risk profile, in your opinion?
Well, the short answer is no, but we're taught that fewer securities is higher risk, and more securities diversifies our investments. And to the greater extent that is true, but the value of diversification does have its limits. And when developing the pensions and considering that we'd be using some of the NCM active portfolios and the holdings, I did a compare and contrast in some of the competition, and I did mention it before. We found some companies that had one, for instance, it'll remain unnamed, had over 3,000 different positions across about 12 funds in their balanced global. And I looked at that and I thought, when you have that many pieces, you've got the overall market, and when you own the market, simply buying the index would probably be cheaper. So we think it's important to be able to target characteristics as part of the risk mitigation, along with the diversification. So I think we're well diversified across our regions and the 132 equities that we have. But I'll also, point that we can manage our risk by diversifying across both maturities and across credit qualities in our fixed income as well. So yes, diversification is important, but in some cases you can overdo it and you just end up owning the market. We don't own the market.
Yeah, no, exactly. Well said. Now we're in the throes of a market correction here. January wasn't that much fun, not for me, not for you, not for a lot of the advisors on the call. We got, the Fed taking liquidity out of the system, bond yields are up. How has the balanced pension fund held up throughout, again, it's very short term, but you talked about the longer term number. I'm just kind of curious as to your opinion on how it held up throughout the month of January.
Well, January's been another special month. Everybody in investments will know that. We launched the fund into a massive downdraft. We held the fund through the COVID bump, and now we've held the fund through periods where we're having 5% swings a day. But our portfolios have held in very well and actually demonstrated some pretty decent cushions and low volatility through this piece. I'm happy to say, one of the bright spots in here that's caused a decent cushion, as opposed to what's been happening in the market, is our fixed income. As I showed a moment ago, we've got a very, very high component of our fixed income in short term. And so that effect in the rising rate environment has been a great cushion for us. We also own some corporates, so the cash flows have also been decent as well. So January was relatively a terrific month for the fund, but on a risk management, it's been quite adequate in giving us a cushion. Tactically, we've in the equity side, we've been overweight Canada. This has been very helpful. Canada has been a very notable outperformer basically through the end of last year and into, January specifically. And also we've got an allocation to the low vol NCM Core Canada portfolio. So that fund has been a particular standout. So our global funds have been having some bumps over the month, but given its weight in the US, that's not really surprising. But we've held up okay against the performance benchmarks there. And I think it's important to rank the performance by region. Basically it's been Canada number one, non-North America number two, and the USA has actually been holding the overall global markets back. So tactically, we've had an overweight in the non-North American portion of the portfolio. So given that that's number two, that's also been quite helpful. It would be impossible not to talk about our unique investments in the real and renewables and new economy. They are primarily U.S. positions. They do have a high sensitivity to the what's going on in the U.S. market. So they're down alongside with the S&P 500 for the month, but a month a short period of time. And these are high growth companies, so I'm expecting a lot from them in catch up. But basically, we've got 5 major capital asset classes in the funds. These are Canada equity, Canada fixed income, USA new economy, and of course, number 5 is the North American. On 3 of those, we've been doing very well, and we're quite happy with the risk profile that they've created through a very volatile month.
So, John, we're bumping up on 40 minutes here, so this will be the final question. We spend a lot of time talking about risk and volatility. We're seeing higher levels of volatility in the marketplace right now. If markets remain volatile, won't that punch up the NCM Balanced Fund above the low risk rated category? What's your thoughts on that?
Well, the volatility we experienced in January demonstrates just how much equity markets can swing around any given fund that's got even a slight overweight to equity. If an investor owns a decent amount of equity, it's going to bleed through in the volatility numbers. So, we'll be impacted by that, and our rating might actually move up a notch. But with that said, the forces that are going to move our risk numbers up are going to take our competitors, which are already at higher risk ratings, and they will invariably go up as well. So if they started out with a higher risk rating than us now, then they'll most certainly end up with a higher risk rating than us in the future. So it's impossible to completely avoid the volatility. We might see a notch go up, but we're still going to remain very, very well in comparison to the competitors that we have out there in this particular space, global neutral balanced.
Yeah, and I think we got a bit of cushion here as well, because we're sitting really well in that low risk rating category bucket that I was referring to either. So anyways, John, wonderful getting your insights on this. Thank you to everybody that joined the webcast today. Again, we will make this available to you if you want a copy. If you have any questions, we didn't get to the questions today, but if you have any questions, feel free to follow up at sales@ncminvestments.com, and we'll do our best to get back to you in short order here. Again, everybody, enjoy the rest of your day, enjoy the rest of your week, and thank you for your time today.